Ladies and gentlemen, good day and welcome to Q2CY26 earnings conference call of Cockerill India Ltd. Before we begin, this conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I would now hand the conference over to Mr. Francois David Martino, Chairman of Cockerill India Ltd. Thank you, and over to you, sir.
Thank you, and good evening and a warm welcome to everyone joining us today for our Q2 calendar year 2026 earnings call. I would like to start by apologizing for the delay taken for the call, and this is due to board of directors, which has been longer than expected. So I'm joined today by our Managing Director, Mr. Fred Martin, our CFO, Mr. Deepak Shindakar, Company Secretary, Mrs. Lidi Salungpuria, and SGA, our Investor Relations Partner. We have uploaded, as you may have seen, our financial results and investor presentation on the stock exchanges and on our company website. I hope you have had an opportunity to go through that. Let me begin with a brief overview of the steel industry and the current market environment. The global steel market remains mixed across regions, with different markets facing different opportunities and challenges. Let's start with Europe. Europe continues to face a challenging environment. High energy costs and weak industrial sentiment are affecting investment decisions. In July 2026, the European Union introduced a new tariff quota regime covering 18.3 million tons across 26 steel product categories. Imports beyond the quota are now subjected to a 15% duty, while the new melt and pour requirements calls for proof of the steel's true origin. Slabs remain exempt from the quota and duty, and this is an important information, because these changes the driving forces and increase the interest for investors in implementing hot rolling solutions, cold rolling solutions, and processing lines based on duty-free imported slabs. They are also supporting the localization of steel making through electrical arc furnaces. While in China, the country remains the world's largest steel producer, but the market is changing. The country is moving towards what can be described as a green steel pivot. In April 2026, finished steel exports declined by 9.2%, while sector value added increased by 1.8%. This points to a gradual shift towards higher value and more specialized steel products. Chinese producers are increasingly looking for downstream lines, such as galvanizing, annealing, and finishing to support these products. At the same time, there is a significant investment in electric arc furnace and hydrogen-based metallurgy to reduce emission. Customers are also becoming more selective about capital investments. There is a stronger focus on advanced technologies, productivity, energy efficiency, and decarbonization. We are responding to these changes by strengthening our presence and capabilities in China. The United States steel industry is seeing a revival. Capacity utilization reached 82% in July 2026, the highest level since 2018. Producers are expected to invest more than $14 billion this year, including major projects such as Nucor's new sheet mill in Arizona. We are also seeing strong growth in the localization of spare parts and maintenance services This is a further strengthening the domestic industrial ecosystem. India continues to be one of the strongest growth markets for steel. Steel production is expected to reach this year 161.7 million tons, with an unchanged target of 300 million tons by 2030. Major infrastructure programs and production-linked incentives for specialty steel are supporting more than $25 billion in investments. At the same time, per capita consumption in India is around 93 kilograms only, compared with the global average of approximately 230 kilograms per person. There is a huge gap which needs to be closed in the future. This highlights the significant potential for further growth. Infrastructure spending remains strong, manufacturing capacity is expanding, automotive demand continues to be healthy. These factors are creating a favorable environment for further investment in steel. Other emerging markets like Africa and South America are also showing healthy growth, with steel demand expected to grow by around 5.5% in 2026. Brazil and Argentina remain key markets in South America, while East and North Africa are benefiting from increased infrastructure development. These regions are becoming increasingly important to the future growth of global steel demand. Beyond the regional development, there are several common trends shaping the steel industry. Steel producers are moving towards higher value and more advanced products. This is increasing the need for advanced processing technologies. We are seeing growing demand for galvanizing and cold rolling lines, along with strong interest in electrical steel processing. At the same time, customers are looking at plant modernization, energy efficiency, and life cycle services. Decarbonization is also becoming an increasingly important part of investment decisions. Geopolitical tensions, particularly in the Middle East, continue to affect energy markets, logistics, and global commodity flows. This is creating some volatility across industrial markets and making flexibility and local support increasingly important for our customers. These industry trends are closely aligned with our capabilities and with the technology portfolio of the John Cockerill Group. Our focus is therefore on strengthening our presence in key markets, supporting customers with advanced technologies, and increasing our ability to provide local support and lifecycle services. Overall, while the steel market remains challenging in some regions, we see significant opportunities driven by capacity expansion, higher value products, decarbonization, plant modernization, and the need for greater efficiency. This gives us confidence in the opportunities ahead. The previous quarter marked the beginning of a new chapter for John Cockerill Industry India. We consolidated our Chinese, German, and Belgian entities under GCL, and this is an important step for our strategy. The objective is to create a more integrated and agile organization, and we are bringing together technology expertise, manufacturing capabilities, and execution strengths. We are also creating better access to the Chinese market. This integrated platform will help us work more efficiently. It will also help us respond faster to customers. Most importantly, it will allow us to offer our global technology capabilities through a stronger and more coordinated organization. We believe this will support our growth in the coming years. Coming to our performance during the quarter, we delivered another quarter of strong year-on-year growth. Standalone revenue grew by 82% year-on-year and reached approximately 149 crore in quarter two of the calendar year 2026. Consolidated revenue stood at approximately 299 crore. These represent a growth of 18% year-on-year also. Revenue was lower on a sequential basis. This was mainly due to the project cycle and the timing of revenue recognition. In Q1, several of our other projects were close to completion. We were therefore able to recognize the savings and efficiencies achieved on this project during the quarter. This supported the margin in Q1. While in Q2, the situation was different. We have started execution of a number of new orders that we secured very recently. These projects are still in their early stages, and at this stage, we incur several initial project costs. However, revenue and margin contribution build up progressively as the projects move forward. And this has resulted in lower revenue volume and lower margins in Q2 compared with Q1. This is therefore largely a matter of project timing and mix rather than a change in the underlying business momentum. We continue to see healthy customer inquiries. More importantly, we are seeing a strong pace of order wins. Our customers are investing not only in additional capacity, they are also investing in better technologies. We are seeing demands for advanced processing technologies and electrical steel, as well as investments in downstream quality improvement and plant modernization. The reasons are clear. Customers want to improve productivity and reduce energy consumption. They want better product quality, and they want to meet their sustainability and decarbonization objectives. These are long-term trends. They are not limited to one quarter or one market. These trends are closely aligned with the strengths of John Cockerill. Our order book continues to grow strongly during the quarter. We secured order worth approximately 1,200 crore. With these wins, our total order book as of June 2026 stands at approximately 4,500 crore. I have to say this is a strong position for the company. It gives us good visibility for the coming years, and our focus now is very clear. We need to convert the strong pipeline into further orders. And at the same time, we need to execute the existing order book well. Good execution will be critical. As these new projects progress through their execution cycle, we expect the revenue and margin contribution to build progressively. We believe our strong order pipeline, combined with our technology portfolio and execution capability, gives us a solid foundation for the next phase of growth. And let me now come to the profitability. Profitability during the quarter was affected by the project mix and the earlier stage of execution of the new order, as I previously mentioned. Several new projects are currently at the beginning of their execution cycle. This means that some costs are incurred upfront, while the corresponding revenue and margin are recognized progressively as the project advances. We also incurred certain upfront costs to build the organization and capabilities required for the next phase of growth. In addition, we have some one-time costs related to the consolidation and integration of our operations following the group restructuring. These factors affected our profitability during the quarter. However, we see these factors largely as transitional. The changes we are making are aimed at building a stronger and more scalable organization. They will improve coordination, improve execution, and help us serve our customers better. As the new projects progress and the benefits of these organizational changes start to come through, we expect profitability to improve over the medium term. Our priority is therefore not only growth, it is profitable and sustainable growth. And if we look beyond our current order book, we continue to invest in new technologies. One important area is jet vapor deposition. We are continuing to develop this technology and build market opportunities around it. We see this as an important part of our long-term technology strategy. More broadly, we believe the next phase of growth in the steel industry will not be driven only by capacity addition. It will also be driven by technology, productivity, energy efficiency, and the need for more advanced products. This is where we believe John Cockerill has an important role to play. We are also strengthening our capabilities closer to our customer. And recently, we inaugurated our advanced coating facility at Taloja in India. This is an important addition to our value services. It will allow us to support customers with advanced coating solutions and further strengthen our position in the services and energy efficiency business. In China, we have also opened a new office in Shanghai. This is an important step in strengthening our local presence and bringing our technology and expertise closer to customer in the region. The Shanghai office will also support our broader expansion in China. We are now preparing to open a workshop in China in the third quarter for the assembly of special machines and equipment. This will give us additional local capabilities and help us respond faster to customer requirements. These investments are part of the same strategy. We want to be closer to our customer, we want to strengthen our local capabilities, and we want to combine these capabilities with the technology and expertise of the John Cockerill Group. To conclude, I would say that the direction of the business is clear. Our order book is stronger, as you have seen, and we have a robust pipeline. We have enhanced our execution capabilities and now have a more integrated global operating platform. We are also investing in technology, local capabilities, and customer proximity. Be assured that India continues to offer significant opportunities for the steel industry. At the same time, we see important opportunities in China as well, in the US and other international markets. We believe the medium and long-term opportunity for GCL remains substantial. There will be always challenges and execution and some quarter-to-quarter volatility. This is part of the business model. But our focus remains unchanged. We want to grow the business, execute well the projects, and improve profitability and create sustainable value for our customers and shareholders. We are now happy to take your questions, of course. And as a closing remark, I would like to thank you very much for joining us today. We are very pleased to have that opportunity to speak with you again. We appreciate your questions and your continued interest in the company. As mentioned, we remain available for further discussions with our investors. The management team will be happy to continue these discussions offline as well. Thank you once again. Have a good day.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Milandeep Jain from Green Portfolio. Please go ahead.
Hi, thank you for the opportunity. My first question is around the mentioned acceleration of 8,000 crores of top line, which was mentioned in the Q3 calendar 25 call, driven by new technologies like JVD, Voltron, and external growth. So I want to understand, is the 8,000 crore top line target by CY26 is still the internal target?
Great. Thank you for your question, and we are happy to respond to these questions. And the 8,000 crore target, it's not only a target for the complete organization and the management team, but this is the North Stars we are following every night to find our way to success. These 8,000 crores are going to come from different streams, and we have identified two main and major streams. One is our organic growth, and as you rightly has underlined, this growth will be largely supported by JVD, and we believe also Volteron. The second revenue stream will be based on external acquisitions, and currently the management is investigating several external acquisition as well. So this is the two revenue stream that we want to integrate together to build a very comprehensive and logical group. Now coming back to JVD and Volteron, as we several times mentioned, JVD is already commercializable, and we have very advanced discussion to close one project, hopefully this year, for JVD in Asia. I cannot mention more precisely where and with which customer, while Volteron is a technology which has been developed by our headquarters in Belgium, and the IP is belonging to John Cockerill SA today and not John Cockerill India Ltd. Nevertheless, the management team is in discussion with our headquarters so that the full business case integration of Volteron can be done effectively within short. We are not at the commercialization stage for Volteron, since we have some R&D tests to finalize before we can bring that up to the market. Between the IP we have today and the full industrialization of Volteron technology, there will be several milestone steps in order to have pilot plants validation and clear customer demonstration modular projects to show the efficiency and the ROI of the technology. Hopefully this answers your question.
Thank you for the detailed explanation. My second question was about that you guided a pro forma consolidated calendar year 25 revenue would be closer to around 2,000 crores. And Q1 calendar year 26 filing we stated the calendar year consolidated revenue as 960 crores. So which is a gap of roughly around 1,000 crores. So I want to understand, my question here is that the US entity is not yet consolidated, but that alone does not bridge the full gap, I believe, because you also mentioned on the call that the US contribution would be relatively small. Could you please help me reconcile this difference?
Yeah. Can we ask you to clarify your question, please, on the 1,000 crore?
We cannot hear you very clearly. If you can speak maybe come a little closer and yeah.
Yeah. So my question was that the consolidated calendar year 25 revenue was guided to be close to around 2,000 crores, and actually the reported number was around 960 crores. So the gap of this 1,040 crores, I want to understand, will it be bridged by the US entity alone? Because as per my knowledge, the US contribution would be relatively small. So can you just help me how this gap will be bridged? That's my question. I hope I'm clear now.
So I think the 2,000 crore was kind of a guideline or a target. You're right that US is not a very large contributor to that, though it is not insignificant. But most of our turnover is related to how we progress our projects. One is when we get the orders, and then how we progress on our projects. So I think you will see a significant improvement in the revenue generation in the second half. And I think, okay, we may not be at 2,000, but I think we should not be very far, if at all we include the U.S. in that.
Okay. Thank you, sir. Also, one last thing. I want to understand that the John Cockerill actually reduced its holding from 75% to around 70% in Q4 calendar year 25. So I want to understand what the reason behind it. Was it driven by SEBI disclosures or some group level liquidity needs or something else?
Sorry, we could.
Hello?
Hello.
Yeah. Am I audible now?
Yes, sir, you're audible. Yes,
Hello?
Mr. Milindip, go with the question, please.
Yeah. So I believe I am audible. My question was that the John Cockerill also reduced its holding from 75% to 70.4% in Q4 calendar year 25, selling around 2 lakh shares. So I want to understand what's the reason behind it. Can you just please elaborate, and should we expect any further reductions?
Yeah. So, John Cockerill has 75%, had 75% shares. I think it's a large holding. Obviously, being a global player, they have their priorities, they have their projects. So, once from time to time, they may want to do certain operations on their holdings and on their investments. So they remain a very large shareholder, at a plus 70%. And as you are aware, we will be now issuing the preference shares to them, which are convertible, and to that extent, they will again go back to 72+%. So they remain. I mean, they are the most interested shareholder of this company, and they will remain interested in the development of this company. So I think a small reduction like this it should not be a cause for concern. Yeah.
Okay. Thank you so much, sir. Just one last question was around the Fallujah rolls coating facility. Can you just give me a revised date for the first revenue we should expect from this facility, and what's causing the repeated delays?
Fallujah advanced coating. Okay, it has been put in operation in June.
Yeah, the facility is now operational. We are doing some of the testing, and we have some trial orders. So we will start exploiting that facility as we go forward. Yeah.
Yeah, we're initiating production now.
Yeah.
Production now.
That's all from my side. Thank you so much, sir.
Thank you very much.
You're welcome.
Yeah.
Thank you. The next question is from the line of Prateek Giri from Shubhlas Research Private Limited. Please go ahead.
Hi, greetings. Thank you for the opportunity. I hope I'm audible.
Yes,
Sir, my
you are.
first question is on... Thank you. My first question is on JVD. Sir, given this process brings real economic benefits, as per our assessment on zinc coating, what has been the customer's biggest apprehension and feedback, in they are sharing with you when you are presenting it as a technology for implementation? If you can share a few nuggets, any anecdotal example which customers have shared with you.
All right. So basically, we have different discussions ongoing. And we had also different discussion last year for JVD. So just as a reminder, the technology JVD is different from the classical hot dip galvanizing process, where basically you deep dive the steel into a bath of zinc to have an anti-corrosion coating. That's the way we do zinc coating since more than decades. Jet vapor deposition, or JVD, is a process where you are projecting vapor of zinc on the strip instead of hot dipping it, and these bring a lot of additional advantage. The first one is that you can run high speed with that. At the same time, you can really have a coating which is more precise and with the same thickness, having enhanced capabilities of fighting against corrosion. So there is a lot of advantage. There is industrial lines running in Belgium, which is proving its efficiency. And the process of concluding the first contract is longer than expected due to internal validation process at customer site. We are not talking about technical validation, but investment process validation. Be reassured that we have, besides this case, we are following very closely, and we should start soon, other cases under discussion.
Got it, sir. No, this is helpful. So, just a follow-up on this, if you can help us understand the cost differential between HDP and JVD. So, for example, if someone has to put a certain metric ton of HDP and he replaces it with JVD, so what is the initial investment difference between the two processes, and how in OPEX the two processes are different per ton basis? If we do zinc coating via HDP or JVD, what is the cost differential on running basis?
So I cannot give very precise figures because it's really depending on the product mix that the customer is using. So let's say that the harder the material is, the higher the benefit. The first benefit is because you are running on higher speed than a CGL, you are doing a lot of savings because you can process much more material with the same line. The second advantage is that you have zinc saving because you are more precise in using your zinc than on the hot dip, and there is a savings based on that. But I would say the largest savings comes when you are applying to automotive steel and advanced high-strength steels, because in this case, you can shortcut the whole production process by avoiding batch annealing process, which is extremely costly. So I would say in terms of savings for the customer, we are talking about cases where it is at least 1,000 rupee saving, and it can go up to 20 times this figure based on the case. So it's a significant impact.
No, this is really helpful. Just one tiny follow-up again. The order which we are supposed to get this year, which probably you mentioned in your opening remark, what can be the typical size of that order, sir, if you don't mind sharing?
The order that we got are two types. One was for cold rolling mill.
JVD order.
JVD order?
That you will get in.
No, it says order since
Hopefully we will
the
get.
year. Hopefully we'll get. The order that we are looking at is in the range of 50 to 100 million euros.
50 to 100 million euros. No, this is again helpful. Just one last question on the cost side. So this quarter, if we try to understand, the cost structure, probably we are at 68 crore employee cost and 70 crore other expenses. So should we take this cost base as a quarterly run rate going forward, or do you see there can be some escalation in these two costs going ahead?
No, I think the employee cost may go up a bit because, we have to expand a lot in terms of our capacity to execution. So to that extent, yes, we'll have to add manpower on the execution side, and that will have some impact on the employee cost. On the other expense side, I think we could be less than what it is, slightly less than what it is. It won't be more than that, yeah.
So you think on other expenses, it can be lower than the current quarter's number in the next 2 quarters in the year?
Marginally, not
Marginally.
huge, yeah.
Right. No, this is very helpful. I'll join the queue back. Thanks a lot. And a good set of numbers in challenging environments, sir. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Rabindranath Nayak from Nirmal Bang Securities. Please go ahead.
Thank you for the opportunity. Good evening, sir. Hello, am I audible?
Yes, absolutely. Good evening.
Okay, sir. Sir, regarding this, what is the order book for FY? You have given that, I have not seen that. Can you please give the order from the standalone and also the consolidated entity?
Order backlog. So the consolidated is around 4,500 crore, and the standalone is half of it.
Yeah, 2,200, yes.
Okay. And sir, what is the service revenue we have booked in this quarter, and what was in the previous quarter in the standalone and consolidated entity?
Yeah, just 1 second. We are looking for the figure.
Yeah. You can ask the next question till I look for the number, if you have any.
Okay. And regarding the top customer, in the particularly standalone entity I'm referring, what is the contribution from the top customer from India? That is one. And the other one is, out of the 140 crores of, standard, non-standard, subsidiary revenue, what is the contribution of different regions? If you can specify that.
Okay, you can ask your third question while we are looking for the second as well.
Okay, those are the questions, sir. Those are the questions. One is the service contribution. The other one is you have given the order book, service contribution. The other one is your top customer contribution, particularly from India. What is the contribution for top customer? And region-specific sales, if you can provide it, that would be helpful. Particularly from China and Europe and in.
So the service one, I think this quarter was significantly lower than the last time. We are talking about maybe around almost 1/3 of the first quarter, and even in terms of the ratio to the total sales, the value services was lower. This is not because of the lack of orders, but this is because the progress on those projects was less. I think our order backlog in this area also looks very good, and our margin remains very strong as far as the value services are concerned. Yeah. And top, I think the top will be almost.
And I understand around the top contributors are Tata Steel and JSW, and on the consolidated will be adding ArcelorMittal to the top contributors.
Yeah, and that will come to around. I mean overall it will be 80% total. Yeah, around 80%. The top 5.
Okay.
Yeah.
Okay. And sir, if you can give the reasons, and another question I want to ask about this, among the 4 competitors in India, who, according to you, is giving the top, giving coming to when you go to ask for the orders, who is the main competitor which comes with you in terms of competition in the order booking from your Indian customers particularly? Among the top customers.
We focus on our products and our service capabilities rather than focusing on the customer. I think that is
on the competition.
Yeah.
No, I am asking about the competitors' point of view. Who you consider the most likely competitors in the Indian market?
All the tier one competitors in the steel industry, as we all know them as OEM. So, namely the biggest one that we are dealing with and are well known. So, namely SMS, Danieli,
yeah.
yes, typical.
Okay. But in India, your contribution from so far as the downstream steel is concerned, is with perhaps Primetal or with SMS, sir?
Same.
Same. On the downstream,
Same.
all of these competitors has a downstream technology portfolio as well.
Same.
Okay. And the region-specific sales of the 140 crores.
Hello. Sir, I just request you to rejoin the queue, please, for the follow-up question.
Okay, no problem. Thank you.
Yeah. Thank you. The next question is from the line of Khush Gankar from Care PMS. Please go ahead.
Sir, we recently won an order from JSW, which was a order where our standalone as well as our parent companies also won as a group. We won the 1,200 or 1,300 odd crore order. Can you share some qualitative details with respect to what kind of discussions happened and what kind of impact it had post the merger of the Belgium as well as other companies? So what changed versus, say, what would have been discussion would have been if the merger or the things would not have been there? So any qualitative highlights if you can share regarding that?
Yeah, definitely. There is an advantage, of course, as being now a complete global organization, and our teams in India, our technology teams in India, our sales team get largely supported by our Belgium experts and senior managers, and they were instrumental in the acquisition of these GSW projects. One part, by the way, of the project would be executed outside India, in Europe.
And it will be executed by our subsidiary and not the parent company.
Yes. The parent company is now Cockerill India Ltd.
Yeah, right. Yeah. And sir, the order book execution timeline for the current order book would be?
So currently, at end of June, the order book of the consolidated group is 4,500 crore.
Yes, execution timeline for that, sir?
So the timeline is up to 3 years, basically.
3 years. Okay. And what kind of, sir, ramp up can we see in H2 with the new orders execution commencing?
So currently, the hydrogen demand is still very, very weak, and we are really at the beginning of adoption in the steel industry of hydrogen as a reduction factor for, I don't know, Currently, most of the customers are not considering green hydrogen. That means hydrogen coming from electrolyzers, but they're rather pointing hydrogen based on cracking natural gas or by reducing coke oven gas coming from blast furnace or coke oven. So currently, the market is initiating the new process, hydrogen-based, but we are not at the stage where it will come from green electricity and electrolyzers.
Sir, my question was, what kind of execution ramp-up can we see in H2, second half of the year, as first half has been quite slow. So what kind of execution ramp-up can we see for Q3 and Q4, with new orders, execution commencing?
So the hydrogen business of John Cockerill is not consolidated in John Cockerill India Ltd. This is a separate entity driven out of Europe with several worldwide subsidiaries. So I will make no comment on the hydrogen figures of business since they are not part of our scope of activity.
No. So I am asking execution. Can we ramp up our execution in Q3 and Q4?
For the new project.
Yes, absolutely.
Yes, of course. This is planned. And engineering is already in progress. So we will see the ramp up based on the development and the engineering and the procurement actions that will be done before the end of the year. And that will have an impact on H2.
Okay, thank you.
Thank you. The next question is from the line of Bimal Panchal from Bimal Panchal and Associates. Please go ahead.
Hello. Yeah, congratulations for the good set of numbers. And you have given a very optimistic guidance amidst a very challenging environment. And lots of questions which I was going to ask have been asked by previous questioners, and you have answered satisfactorily. So there is no question from my side. Wish you all the best. Thank you.
Can you please repeat your question?
Yeah, my question has already been asked by previous participants. So
Lovely.
No question from my side.
Happy to have answered it.
Yeah. You have answered to the satisfaction. Thank you very much, sir.
Thank you.
Thank you. The next question is from the line of Dhwanil Shah from iWealth Fund. Please go ahead.
Hi, good evening, sir, and thank you for the opportunity. Hope I am audible.
Yes, you are.
Yeah. So, sir, my question was mainly on the geography side, right? If you can just help us understand on the outlook of new orders, what is your sense in terms of India and international after the current order backlog, what you all mentioned? Are there some more order wins that we can expect? What is your sense on that?
Yes. The pipeline for new orders is still very interesting, and we have possibility for new orders in different regions that we are active on. That means that we are still very positive on the Asian regions. We are also positive on the European region. And we still see quite interesting development also in the USA. So there are still orders to be booked before the end of the year.
Sure. And on the India side, sir?
Also on the Indian side, yes.
Got it. And sir, my second question was to Deepak sir. Sir, I think as you all mentioned in the opening statement, there were some one-offs cost due to consolidation which got impacted or which got reported. So if you can just mention what was the quantum of those costs and which may not come going ahead?
So there are both, I think, both one-off as well as certain ongoing costs, because now that we are the headquarter, or we are the parent company for this business, or there are certain costs, basically because of the being parent company, you will have to take care of it in terms of for example, R&D, the technical development, etc. These costs, now we have to share it equally along with others. So I think that is one important thing to remember as we go forward. Some of the, I think the basic costs were in terms of one is the transaction costs, and you would have seen the impact about the impact on the forex, impact on the notional interest that came because of the transaction itself. And fortunately, the parent company has agreed, to go for a share-based payment instead of a cash payment. And to that extent, many of these costs will actually stop incurring. We will stop incurring from the second half of the year. So that will be a significant saving. And obviously, we had to do the legal side of the deal, the audit, the compliances, the due diligences, etc. So those were the costs that were part of this. And these were the costs not only here, but we had to do that in each of those countries, in Belgium, in Germany, and in China. And being a listed company, obviously, there are more compliances for these companies there, which are outside of India. Previously, those were not part of their costs, and now we had to do those costs there. Yeah.
So what would be the quantum of those costs which was recorded in the Q2? If you can help me understand that.
That will be a little difficult to do it. We can come back to you. We can come back to you on that. Yeah. Yeah. We make a note of that. Yeah.
Got that. And sir, one last question was, as the execution ramps up, right? I think earlier we were mentioning that the order execution timeline generally previously used to be 2 years. I think sir mentioned this time it's closer to 3 years. So just wanted to understand on that, and as the execution ramps up, in terms of margins, sir, if you can help us understand how that will shape up going ahead.
Execution time
varies depending on the contracts, and the development over the time is normally on every contract is 2 to 3 years. So the general answer is that from what we see now, 3 years seems to be the proper assumptions.
Got it.
Yeah. You will have some, basically the service projects, value-added projects. Yes, they will be short duration, but they also will be small value. Yeah. So it is more frequently coming, but they are of short value. I think the margins, we have been doing quite well on the margin, and margins are quite consistent, or I would say slightly improving. And in the quarters where we will have a large contribution of value services, obviously we will get a much better product mix, and hence the higher margins going. Yeah. So I think we expect
H2 should kind of reflect that.
Yeah. Yeah.
Got it, sir. Thank you.
Thank you. Ladies and gentlemen, in the interest of time, we'll take that as the last question. On behalf of John Cockerill India Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your line. Thank you.
Thank you very much.
Thank you.